Welcome to This Explainer. If you've just been glancing at the top-line indices lately, you'd probably think, hey, everything in the market is perfectly fine. But today, we are doing a deep dive. We're unpacking a fascinating daily strategy report from July 21, 2026, and its entire goal is to separate headline noise from structural reality. This report executes a totally cold, forensic deconstruction of the market, and it classifies our current setup as a rally on a sandcastle. So let's jump right in and see what the institutional data is actually telling us. We're starting off with this incredibly stark institutional warning from Jamie Dimon. When the CEO of JP Morgan looks at our $39 trillion national debt, looks at the escalating geopolitical conflicts, and flat out says, I will absolutely not buy stocks or long-term treasuries at these prices, well, the authors of our report argue that is a glaring signal. For them, this is absolutely not the time for casual set-it-and-forget-it investing. It's a time for ruthless precision analysis. To get to that level of precision, we're going to dismantle the market step by step. We'll cover 1. Contradictions in macroeconomy. 2. Stealth tightening and liquidity. 3. Structural cliff of equities. 4. Capital shift of smart money. And finally, 5. Institutional portfolio strategy.
Okay, Section 1, Contradictions in Macroeconomy, the Illusion of Disinflation.
So, a massive driver of all this recent retail optimism was June's CPI print, which showed a 0.4% month-over-month drop, bringing the annual rate down to 3.5%. Now, on the surface, that looks like exactly the disinflation we've been waiting for, right? But the report peels back the layers. They note this drop was driven almost entirely by a 5.7% decline in energy prices, and that was based on some very fleeting ceasefire hopes in the Middle East. According to the analysts, this isn't real disinflation. It's a macroeconomic optical illusion. And here is exactly where the contradiction lies. The report points out that this rosy CPI data completely clashes with the harsh reality on the ground. With the ongoing US and Iran conflicts, plus Houthi threats to Saudi oil exports, we've actually seen WTI crude pushed right back up to $85, and Brent crude breaking 91. The researchers view these as structural macro variables that virtually guarantee an inflation reacceleration. To them, the whole disinflation narrative is just broken. Unsurprisingly, the Federal Reserve sees this exact same reality. Fed Chair Kevin Warsh has pivoted to a highly hawkish stance, officially withdrawing forward guidance and bluntly stating that inflation is still too high. Because of this, the market has violently repriced its expectations. The report highlights a greater than 60% probability of a September FOMC rate hike. That officially marks what they're calling a strict re-acceleration of monetary tightening.
Moving on to Section 2, Stealth Tightening and Liquidity, the Evaporating Buffer.
For the last 4 years, the Federal Reserve's Overnight Reverse Repo Facility, the ONRRP, has acted as this massive shock absorber. It provided over $2.37 trillion in liquidity, which really masked the effects of quantitative tightening. But look at this number today, $0. It is completely evaporated. The data shows that the financial system's primary liquidity buffer is just gone.
Which brings us to a crucial concept the report calls stealth tightening. With that Fed buffer sitting at absolute zero, there is literally nothing left to cushion the blow as the U.S. Treasury's general account vacuums up $850 billion from the market to rebuild its cash reserves. The analysts are warning that this severe, under-the-radar contraction in systemic liquidity carries a terrifying tail risk. We're talking about the potential for a 2019-style repo market shock, a forced deleveraging event across the entire financial system.
And you can see this liquidity drain causing absolute havoc in the bond market right now. While nominal 10-year yields have hit 4.63%, the report really stresses that real yields, the ones that actually account for inflation, have surged to 1.7%. To put that into perspective, that is drastically above the historical average of 1.0%. It's tracking eerily close to the 1973 stagflation environment. The researchers note that when the real cost of capital gets this high, it structurally destroys the valuation models for long-duration assets. Yeah, especially in tech.
Let's look at Section 3, Structural Cliff of Equities, Dissecting the Fake Rally.
Now, if you just take a surface-level glance, you'll see the S&P 500 recently rallied to 7,509. The Nasdaq is up, and the semiconductor index even saw a massive 5.5% spike. But remember what we just talked about. The foundational liquidity is gone. So what on earth is driving this? Well, the report points to short interest hitting a 2010 high of 3.79%.
They argue that what you are watching on your screens isn't fundamental capital flowing into the market. It's violent short covering. It's just hedge funds frantically scrambling to close out their positions.
And compounding all this fragility is the market microstructure itself. 0 days to expiration options, 0 DTEs, now make up a staggering 30% of all S&P 500 options volume. Just to explain that briefly, market makers who sell these options are being forced into automatic, mechanical buying and selling, which is known as delta and gamma hedging, just to keep their own risk balanced. The report states that this mechanical hedging is artificially suppressing volatility. It's basically keeping the S&P 500 hanging on a very, very dangerous ledge.
So when the report asks the million-dollar question, is this a real rally? Their answer is a resounding no. When you analyze these frantic options mechanics right alongside the total lack of underlying liquidity, the authors conclude that any minor shock, seriously, just about headline or a missed earnings report, could easily trigger an explosive downward gamma squeeze. The whole structure is incredibly brittle.
Section 4. Capital shift of smart money. Following the real flow.
To find the actual truth, the analysts say we have to filter out the global noise. For instance, Tier 1 banks like Goldman Sachs are currently publishing wildly bullish reports on the S&P 500 and AI innovation. But, interestingly enough, their own executives just dumped $34.9 million of their own stock. As the report dryly points out, the official research says buy, but the insiders are hitting sell. Talk about cognitive dissonance.
The report suggests the true signal is actually found by looking at alternative assets. Just look at this rotation. Gold has recovered to over $4,082 an ounce. Silver spiked violently by 4.6% to $59.03. And Bitcoin? It's back up to $66,000. The strategy note defines this as a massive debasement trade. Smart money is aggressively accumulating these assets to hedge against systemic liquidity shortages and fiat instability. They are following the real flow.
All right, Section 5, Institutional Portfolio Strategy Action Plan.
Bringing it all together, the report issues a really clear, decisive strategy for fund managers. They recommend executing a strict 15% underweight in semiconductors, large-cap tech, and long treasuries. Why? Extreme valuation fatigue and those rising real yields. Instead, they suggest taking that capital and shifting into a 20% overweight position in large banks, physical silver, and short-term cash equivalents like jumbo CDs, where institutions can lock in a 4.94% risk-free return. Finally, they strongly advise buying S&P 500 put options to hedge against that tail risk of a downward gamma squeeze.
The analysts argue that institutions absolutely must position for this base case reality. In their view, geopolitics essentially guarantee triple-digit oil prices, which confirms an inflation reacceleration, which in turn guarantees that September rate hike by the Fed. And when the cost of capital spikes like that, they expect the astronomical multiples currently assigned to AI hardware and duration-heavy tech stocks to mathematically collapse. And hey, the catalyst for all of this could literally be tomorrow. The report flags Alphabet and Tesla's Q2 earnings as the ultimate test, specifically their AI capital expenditure guidance. The market desperately needs proof that these massive AI investments are actually translating into real return on investment. The analysts warn that if their profit visibility breaks even slightly, the final valuation justification for this entire market vanishes instantly.
We're going to conclude this explainer with a final guiding maxim from the strategy report. Liquidity is the ultimate arbiter of truth. It's a great quote. You can have all the AI narratives and temporary ceasefire headlines in the world, but in a regime where the Fed's pipeline is totally dry and the Treasury is aggressively absorbing cash, the authors view any unbacked market rally as a fatal trap for institutional capital. The report notes that smart money is currently building defensive walls, moving heavily into cash and hard assets. So considering that evaporated Fed buffer and the Treasury vacuuming up whatever capital remains, the authors leave us with one stark question. Is your portfolio prepared to survive the impending liquidity shock? It's a really fascinating look at trusting forensic data over the daily headlines. Thanks so much for joining me on this explainer, and I'll see you next time as we continue to decode the real market signals.